Welcome back to the Apartment Dealer Show. I am Kris, the Apartment Dealer. And today we're bringing you our year-end wrap-up, our market update. Now, typically we would do this live on stage. I'd be in front of several hundred multifamily investors like you, but times have changed. Most educational events like this are taking place through video. So today we, aside of just the data that we look to cover ourselves here at the Apartment Dealer, we're bringing to you Steve Basham of the CoStar Group. If you're not familiar with the CoStar Group, they are the end-all, be-all when it comes to analytics in commercial real estate. To give you some perspective, for the last 33 years, CoStar has been tracking the commercial markets, multifamily, industrial, office, anything considered commercial real estate. And currently today, they track over 6 million properties. What that means to you is they have the real data. This is a step beyond telling your realtor, hey, can you pull comps off of the multiple listing service? Or, hey, let's do a rent survey. Let's just go to Zillow and see what current asking rents are. This is a much deeper dive that you're about to partake in. As Steve and I discuss what has happened over the course of this last year, we're going to start with where were we pre-health crisis. We're going to discuss the last few months, and then we're also going to take a look ahead. Can CoStar share with us where the market is headed into 2021 and beyond? So Steve Basham is our guest. Steve has been with CoStar now for 15 years. He covers the Los Angeles County submarket, and in particular, the corridors we refer to as the San Gabriel Valley, 91 corridor, 605 corridor. Steve works these markets, and we're pleased to have Steve with us. So Steve, welcome back to the show.
Thanks so much for having me.
Now, we were together about August of this year, and to give our clients, landlords, some perspective, because since March, when this whole health issue had began, investors had become anxious, obviously. There was concern, would tenants be able to pay rent? Come to find out, at least when we spoke in August, tenants were paying by and large, say 95% or better. We took a look at the market. Much of what was already trending through 2018-19 was continuing into 2020, but we wanted to, again, just give the investors some perspective of, after a few months of this health issue, where were we? What effect, if any, had it on the market? And now here we are in December of 2020. And so normally I would be up on stage doing a live event for about 200-300 landlords. Those events are gone for now. This really will serve as our year-end market wrap-up for our clientele. And we thought, who better than to have you, who specializes in all things data points for Los Angeles County multifamily. So first of all, how things been since we last spoke? I hope all has been well.
About as well as can be expected. I think like just about all of us, just adapting to working from home and social distancing and all the changes that the pandemic has wrought. But the news these days is vaccine-wise is a little more encouraging. So I think, like all of us, we're just like everyone, just kind of treading water, trying to get through these last few months and hoping to get back to something resembling normalcy next year.
And that's a good point. There's really been, at least in my opinion, or going to be 3 segments of this thing that we just lived through. There's going to be the pre-health crisis, the current status of which we're in, and then, like you said, after a vaccine or whatever the answer may be, the market that will come after that. But maybe let's start there, because I think for a lot of investors, landlords who aren't looking at the data every day like you and I, they just assume their gut tells them the market must be in a slump just because of everything going on, and with lockdowns and the economy hurting and so forth, the market must be in a slump. But the minute we have something like a vaccine, the market's just going to take off and sky's the limit. So maybe if you could set the tone for us, where were we pre-March, pre-lockdowns, and where have we seen things take shape?
Okay. So we had, in the data biz, a lot of times we'll look at things on a quarterly basis. That 3-month chunk is a convenient and useful window to sort of look at how a market moves over time. So in 2020, we had about 1 quarter of pre-pandemic information, right? The pandemic really started to intensify right at the end of March. So we had about 3 months of normal, if you will, data to look at. And what we saw at the end of 2019 and at the beginning of 2020 was that even before the pandemic, there were some signs of cooling in the LA apartment market. Most of the last decade, the 2010s, was a period of really unprecedented growth in LA from a rent growth perspective. Vacancies were among the lowest of any major market in the country. And while LA is always a difficult place to build, new construction and particularly high-end new luxury construction was at the highest levels that CoStar ever tracked. So from a macro level, which is typically where I kind of operate, for most of the decade, the LA apartment market was really firing on all cylinders. And really, it wasn't until mid-2019 and early 2020 that characterization started to change a little bit. Definitely not anything disastrous, but the pace of rent growth was starting to slow. So whereas in the mid-decade last year, we were seeing at a market level 4 or 5 or 6% rent growth. In 2019, annually, we saw about 2% rent growth. So again, that's pre-pandemic. So already kind of a noticeable slowing. Similar in the other major indicators that we track, vacancies or occupancy levels. While overall vacancies in the market remained very tight, new projects that were opening up were having a lot more trouble landing tenants. So as new projects, typically in central LA or on the west side, these are high-end luxury properties. Earlier in the decade, they would lease up typically within about a year of opening. We had a lot of projects that opened near the end of 2019 and beginning of end of 2018. Beginning of 2019 downtown that had still not stabilized when the pandemic hit and has still not stabilized today. So there was definite indicators that decade or 7-8 year run of just red hot growth was starting to cool. And really the prime culprit for that was likely just how expensive things have gotten. Because as I said, vacancies were still very tight. There wasn't a lot of weakness in the market that you would point to say that's why rents aren't growing as quickly as they did in the past few years, other than the fact that the spread between rents and incomes had really increased. You just have a much more sizable portion of our population that can't afford to live here. LA's population actually declined a little bit in recent years as cost crunch households moved to more affordable parts of the country. So that affordability crunch, and it was probably our main indicator that decade or so of just outsized rent growth had pushed rents about as high as the market could bear in a lot of cases.
And this is something that we've spoke to at our educational events. Essentially, what percentage were tenants utilizing of their discretionary income towards rent? And we've been doing these events for about the last 11, 12 years now. And you saw, starting back in 2008, and then, that percentage increasing from 35% to 40% of their discretionary income. So last time I was on stage in 2019, in some areas, tenants were utilizing about 55% of their discretionary income. So we were sounding the alarm of much of what you said to landlords. Look, do you think that tenants are going to utilize 60%, 65%? I mean, at what point do you think there's a breaking point here that now we'll begin to see rents start walking backwards. And that's exactly what we started to see.
Just to your point about rents walking back, I do think it's worth pointing out that we weren't seeing rents falling prior to the outbreak, or rent declines. It was the pace of growth was slowing. So whereas earlier in the teens, we would see 5 or 6% growth, year over year annually. That was slowing to more in the 2 to 3% rate in a lot of places. So it's still positive, but just not that outsized excessive growth that we saw for most of the last decade.
Now, much of the data that I've used for our educational events for landlords, 90% of it comes from CoStar. And so I know that you've brought a bag of goodies for us today to go through, and so we can really update investors where we are. So why don't we go ahead and take a look at your numbers and see where we are.
Okay, so today I thought we'd just kind of take a walk through what is sort of our standard state of the market presentation. We're going to try to gear it toward the parts of town, the parts of Los Angeles County that are most interested and most relevant to your clients and your audience. So that's kind of our framework today. We'll look at LA County as a whole, which is our Los Angeles market, and then narrow it down to look at sort of the San Gabriel Valley and then some of the Eastern LA County. And I do like to always start off with emphasizing and reminding people just how big Los Angeles is. I think even people who live here, it's easy to lose perspective. So that's LA County there in red in the lower left-hand corner there. LA County has the same population as those 11 states in blue combined. So it's absolutely massive. When you talk about the local economy, it's even bigger. There's only 3 states in the country, New York, Texas, and California, that have a bigger GDP than the LA metro region. So, we'll talk about the LA County today or the LA market. But it's really a state-sized entity in terms of population and economy. So it's just a massive area and good to keep in mind. And one of the reasons today that after we kind of look at LA as a whole, we'll try to narrow in a little bit on what we would call the submarkets that are a little bit more relevant. And here that's going to be Pasadena, which is up in this area. The San Gabriel Valley, which covers a long, pretty large geography from Alhambra and Arcadia over to the Inland Empire here, and then Southeast LA, kind of running along that five corridor down there, 545. So just kind of setting the framework for what we'll be looking at later on when we talk about those individual submarkets. In CoStar, we look at market level information, which is all of LA County, and then we track 36 individual submarkets within the LA market and try to get detailed information on market trends, within those smaller areas as well. So one thing to remember about Los Angeles, we talk about how hard it is to build here, and that's not a new phenomenon at all. So, one thing to remember about LA apartments is, on a whole, they are much older and less fancy, less amenitized than what you see in the United States as a whole. This pie chart breaks down the Los Angeles apartment inventory and the United States apartment inventory by the decade they were built in. So you can see in the United States here, more than 25%, over 30% of apartments were built since 2000. And when you look at it the other way, only about 30% of units in the United States were built in the 1970s or before. Those ratios are pretty much flipped on their head in Los Angeles. You can see that only about 10% of local apartments were built in the last 20 years. Meanwhile, nearly 3/4 of the LA market inventory is over 50 years old. It was built in the 70s or before. So it's something to keep in mind if the LA renter sort of seems permanently aggrieved or permanently in a bad mood. Not only are they paying some of the highest rents in the entire country, but oftentimes they're paying top dollar for older, less amenitized apartments. So they're not getting much bang for their buck either. And that may even lead to some reasons why we saw some renters leaving LA in recent years for other parts of the country. Your dollar is going to stretch a lot farther in other places where there's been more new construction and more new supply. Let's just illustrate that just by looking at the San Gabriel Valley. So this is sort of our San Gabriel Valley submarket. We also break it down into the different neighborhoods there. But all told, we've got a little over 62,000 market rate units in the San Gabriel Valley in about 3,500, 3,400 properties. So I say market rate because all this data we look at today is going to exclude things that don't move freely with the market. So subsidized housing, senior housing, student housing, things like that are not included in what we're looking at today. So you got a little over 6,200 market rate units. Now, CoStar uses a 5-star rating system to kind of rate the quality of buildings. So our 4 and 5-star ratings are essentially your Class A properties, your top of the market. So of those 62,000 plus units in the San Gabriel Valley, only about 3,300 of them are in 4 and 5-star properties. That's 4 and 5-star units in just 16 properties. So really not a lot of this high-end luxury development in the San Gabriel Valley. Meanwhile, you've got about 14,500 3-star, sort of your Class B inventory in about 300 properties. But really, almost everything, the bulk of inventory is in this Class C space, this 1 and 2-star inventory. And that really is kind of what dominates and what is prevalent in the San Gabriel Valley.
And much of our viewer base owns C-class type properties. Much of our viewer base own, say, somewhere between 5 to 50 units. Typically, those buildings are going to be built in the 50s and 60s. So this data, really speaks to them, or obviously the bulk of the data speaks to exactly what they own. And I just want to reiterate for the viewers that, you really are getting a treat here with Mr. Basham's data and time, because this is 20 steps beyond telling your realtor, hey, just pull me comps from MLS. That doesn't even touch the surface of what we're about to dive into and what CoStar tracks. So, yeah,
and maybe that's a good spot to just say real quickly kind of how we get this data. So CoStar, we own apartments.com and a network of listing sites. So any community that is marketing their availabilities on apartments.com or one of those other sites, Westside Rentals, anything like that, that's all going to be filtered into the analytics side of CoStar, so we can look at that information. We have a research team of several hundred people who call out to communities that are not marketing their properties on one of our listing sites to gather information there as well. And all of that is kind of rolled up and used to estimate rental rates and vacancy rates in any properties where we don't confirm data. And then so the data we look at today is sort of that all rolled up holistic number that results from all the research efforts and then the modeling and everything that we do. So it's an attempt to look at the entire market, every property, as opposed to whatever happens to be on the market just right now and marketing their listings right now. So San Gabriel Valley, a massive, one of the largest apartment submarkets in Los Angeles in terms of number of units, but hasn't seen a lot of new construction recently. So inventory kind of slanted. Most of it is that sort of older 40, 50-year-old product or more sort of workforce housing there. So when we look at LA as a whole, this chart looks a little intimidating, but we'll walk through it here. This looks at supply, demand, and vacancy. So, it's a good way of just kind of gauging where the market is moving. The relationship between supply, which is new units, how many new units are built in a given year, and demand, how many units are leased in a given year, is what kind of determines the vacancy rate, right? So what we're seeing here, the yellow bars are a measure of leasing or what we call absorption. It's just relative to the previous year, how many more units or fewer units were occupied. And then the other part of that coin is new supply, deliveries. So how many new units were built in a given year or a given quarter in this case. And you can see when leasing or demand outpaces supply, like we saw, in the early part of the recovery last decade, that the vacancy rate's going to trend downward. So after the housing crash and the great financial crisis, we saw several years where demand trended negative, meaning more units became vacant than were vacant the quarter before. At the same time, new units were still delivering, and that pushed the overall vacancy rate higher, up to about 5%. Then for most of the last decade, you will see these yellow bars keeping pace with or higher than the blue bars. So demand, the demand for apartments outpaced the rate at which we could build new supply. And as a result, you see the vacancy rate trending downward. This is our historical vacancy rate, this red line in Los Angeles, which historically sits just above 4%. And you can see we were even lower than that for most of the last decade, that we had vacancies trending at or below 4%. And a lot of that is because it's tough to build in LA. It's a metro, we saw how big it was in that first slide, right? As big as 11 states put together. In a lot of quarters, we're only building, 1,000, 2,000 new apartment units. That sounds like a lot for just a nominal number, but in a metro of 10 million people, that's just a drop in the bucket for new housing, right? So demand is generally there to keep up with whatever we can build, and as a result, vacancies stay very low. Now, I mentioned in the introduction that we began to see that change even before the pandemic hit. This is getting into this area here, 2019. And you can see that we had a lot of new product deliver around the end of 2018, 2019. Much of this was new luxury stuff that delivered downtown. So within a couple quarters here, we had about 10,000 new units hit. And demand for the first time really did not keep pace. You see in some of these earlier quarters when we have these spikes in deliveries, the demand, the yellow bar stays right there, and then these properties lease up quickly, right? Not the case so much in 2019. And while demand was starting to accelerate, in this area, then in the last quarter of 2019, the first quarter of 2020, again, before the pandemic hit, we see negative absorption for the first time since the last recession. And you see the vacancy rate really jump there to the highest rate we've ever tracked in Los Angeles, to above 6%. Worth noting there that while that is likely a record high for Los Angeles, that's still a pretty healthy rate from a national perspective. Prior to the outbreak, the U.S. vacancy rate was about 6.5%. So even with several of the worst quarters the LA apartment market's ever posted, we're still not to where the national rate was prior to the outbreak. And that, just go ahead.
No, I was just going to interject here that, looking at this chart, the viewers have lived through this. And so they understand that about 2008, 9, and 10, in the San Gabriel Valley, which you pointed, but even in the Inland Empire, the 605, 710 corridors, vacancy crept up, but maybe to about 5%. So nobody was doing extremely bad. Currently, vacancy is creeping up, but you primarily see it, and I'm curious as to your input here. Of course, we know the luxury apartments are taking a hit. There's issues because of the health crisis, let alone the asking rents on a lot of these new construction places, because they have to ask high rents in order to make it financially, worthy of having built it to begin with. But even when we look at the San Gabriel Valley, for instance, if we say, okay, we have to classify A, B, C areas in the San Gabriel Valley, a lot of your A areas, if you will, are going to be along that 210 corridor. Well, right now, Pasadena, Arcadia, again, along the 210, you're seeing vacancy creep up. And as I'm speaking with landlords and I'm asking, well, what are tenants telling you? Why are they moving out? It's interesting. Many are buying homes and many are leaving the state. And this goes back to other content that we've covered, that one, given low interest rates and housing, we knew that it would compete with apartments, number one. It did in the last go around as well, and in the last recession. And two, these individuals, because of the types of employment, not just day laborers, if you will, they have the choice to leave the state, and they're choosing to leave, for various reasons. So, any thought on that?
Well, I give my solemn oath to your viewers that you have not seen my slides ahead of time, because it would be harder to make a better segue into the next couple set of slides. that I've got here, because we're going to break it down and look at it, not this top level thing, but kind of break down the different segments of the market, because we're seeing some very interesting trends emerge here. When we did this call in August, we were basically looking at 3 to 4 months of information, and everything was still kind of jumbled up. Nobody knew what was going on. There was still a lot of uncertainty. Now that we've got another 5 to 6 months here, we're really seeing some clear trends emerge. And there's two that I want to highlight today that I think speak to your question. The first is this divergence between the top end, the luxury part of the market, and your more affordable housing. So we've got it by stars here, but we could think of this as A, B, and C class properties, right? So right here, this is the overall vacancy rate, and you can see that while we were talking about vacancies rising in Los Angeles, that it's not playing out equally across all segments of the market. Typically, in the Class A space, the 4 and 5-star space, you see elevated vacancies there. That's where all the new construction is. That's where the supply risk is. That's where the properties that are still in lease up are. So it's not unusual to see a higher vacancy rate there. But what you can see both in recent years and again, just accelerating in this year is that vacancies are really climbing in the top of the market for some of those reasons that you mentioned, right? The renter who can afford to rent a new apartment in downtown or on the west side probably has the finances to go buy a home in the San Gabriel Valley or somewhere else. And if they make that decision, that's going to pull away from the top of the market. Meanwhile, you see pretty strong performance and not much weakness in your more affordably priced Class B and Class C housing. You have so many renters now who are prioritizing affordability over amenities that right now the most important thing is just being able to pay your bills. So this more affordably priced stuff is typically in high demand, even more so since the onset of the pandemic. So you see a slight vacancy expansion in the Class B and the Class C space, but really the overall what's happening in LA when you see the overall vacancy line in LA going up, that's largely being driven by the top of the market here. Similar when we look at kind of the submarkets that we wanted to focus on today, Pasadena, San Gabriel Valley, Southeast Los Angeles, when you just think about affordability, right, in very general sense, Pasadena is going to be probably the priciest of those three. San Gabriel Valley, the sort of the middle choice, and Southeast Los Angeles, the most affordably priced. And when you see the vacancy lines moving here, that's exactly how the overall vacancy rate breaks out. We're comparing this to LA as a whole here. That's that dotted black line. So in all three of sort of our target submarkets, all which are more affordable than LA County as a whole, we see vacancies holding lower. And then in our most affordably priced areas, Southeast Los Angeles, you still have sub 4% vacancies. That's an extremely tight market, So definitely some nuance here, and by far the areas that are suffering the most, or the communities that are suffering most, are these Class A 4 and 5-star properties that small floor plans, high prices, typically, a lot of built-in amenities to justify those prices that might be closed now, like the rooftop pool and the gym and all that. So we see this weakness at the top of the market here. So that's one of the two dynamics that I think kind of speaks to what you're talking about. And then we'll jump to another one a little bit later in the presentation here. I did want to, before we moved on, just want to look a little bit at our forecast. And again, this is we're jumping back to LA County as a whole here. So you saw that the degree of vacancy expansion in sort of our submarkets of interest in Pasadena and San Gabriel Valley and Southeast Los Angeles follows a similar trend as LA as a whole, but is much less pronounced, right? The vacancy expansion and vacancy and demand losses are nowhere as close to intense there. So you can kind of use that as a guideline here. We see in general several more quarters of soft demand before the market really starts to stabilize. And really it's likely before 2022, when the vaccine's more evenly, widely distributed, when the economy starts to accelerate again. That's when we really see apartment demand at a county level starting to jump back. But this is not going to be as pronounced in the San Gabriel Valley and Pasadena and Southeast Los Angeles as it is in LA as a whole. For one thing, there's very little new construction going on in these areas, so there's not much new supply that's going to boost vacancies overall. And then we're not seeing the demand losses in these areas be as pronounced because they are more affordable. And that's really where the renter preferences seem to be shifting right now, is chasing affordability.
And I also want to point to, for those viewers who are maybe saying, hey, I don't own in the San Gabriel Valley. It applies to, again, when we're talking ABC areas, vacancy, let's say if you're in that 91 corridor, what we're saying is a city like Downey is going to see more vacancy than an area like Cudahy because of the type of tenant base. Even within a city, so if you own in Whittier, you're going to see more vacancies in Uptown Whittier than you are in South Whittier because of the type of tenant base, the asking rents, and so forth. Now, interestingly, and I want to point this out, is in the Inland Empire, and I read a few articles that CoStar released, while most other areas seem to see an increase in vacancy, a decrease in asking rents, the Inland Empire is one of the few areas that vacancy has decreased, asking rents have actually gone up. Maybe if you could speak to that a little bit, Steve, is that essentially just now that people can work from home, they're choosing to move east for affordability? Why is that happening?
I think you really hit the nail on the head. So yeah, you could argue that the Inland Empire is out of the 300 plus markets that CoStar tracks in the United States. You could argue that the Inland Empire is the best performing market in the country during the pandemic in terms of how vacancies have compressed and how rent growth has actually accelerated. Rents are growing faster now than they were before the economy cratered. And I think you hit the nail on the head, right? If you work in Santa Monica or Culver City and you have been paying $2,500 a month or $3,000 a month for a studio, so you can be within striking distance of your job. And maybe this isn't the perfect example here for the Inland Empire renter, but these trends are playing out everywhere. If you don't need to commute to that central or west side location anymore, why not move out east or to a less dense or more suburban area where not only are you typically saving money, but because the units are older, they tend to be larger too. So in the Inland Empire, you can get more space for less money. And for someone who's stuck at home for 24 hours a day and not commuting to their job anymore, that's a pretty compelling proposition, right? Why am I going to pay to be near downtown when all the restaurants and nightlife is closed and I don't need to commute to my job there anymore, right? That's everything that made those areas compelling has not everything, but a lot of what's made those areas compelling has evaporated. And that's what's really driving these shifts that we're talking about, a move toward more affordable units. And another one that we'll touch on is a move away from denser urban areas to more suburban communities like the San Gabriel Valley and to a lesser extent, Pasadena as well.
And Matt, my tech guy, I think we really should link to maybe a couple of our past live events, because we've been pointing investors towards the Inland Empire for the last 3-4 years. Inland Empire West, if you look at the days on market, it's dropped dramatically because the Inland Empire West, being your Pomona, Ontario, Montclair, Claremont, since it's more affordable compared to Los Angeles County, a lot of investors have flocked there because there also has been a significant run-up in rents. I just purchased a building there that I'll share with you here in a few minutes and what's going on there and why. I put my own capital up in the area. So the Inland Empire West, a lot of money has flocked there. And, people would say, really, do I want to own in Pomona or Ontario? And here you heard it for yourself. Now in the middle of all these health concerns, here's an area that actually rents are going up and vacancies going down. So it's a good place to put your money.
It's counter-cyclical in a sense. And I think inland, a lot of these losses that we're seeing in LA in terms of demand and rent losses, Inland Empire is the direct beneficiary there of where a lot of that's headed.